Let's kind of just join a few dots here. There's a bit of market turbulence out there this morning. Oil's coming down a little bit, not by much. We're kind of 67 on Brent. Is that about the right price?
Feels like it to me. It felt a little frothy at $70 a barrel. There was geopolitical news. The dollar was weak, which always drives the oil price up.
Yep.
I mean, we're planning this year in 55 to 60. This is a healthy level for us to plan. We don't need it at $70 a barrel with what we're planning.
Let's talk a little bit about the company and the metrics that you're posting this morning. Net debt continues to rise. How do you manage that?
Well, our gearing's coming down. You know, we've got a framework that we work within, 20 and 30% gearing. We were up around 29. We're down around 27. Gearing feels fine. It's heading in the right direction for us. We're going to stay, but to your point, we're going to stay very disciplined within the capital framework we've got. We're generating a lot of cash. Cash is up 24 billion in operating cash flow this year. I think we're on the right track.
You're generating a lot of cash, Bob. Does that seem sustainable? Because if so, wouldn't it make sense to raise dividends for shareholders?
Well, back in the third quarter, for the first time, we said that we listened to the shareholders. We have a scrip program, or people want to know what that is. It's like a DRIP program in the U.S., dividend reinvestment plan. People take their dividends either in cash or shares. But we listened to the shareholders and said, stop diluting the shareholders. So last quarter, we bought back about $340 million of shares. We'll keep going with that scrip buyback program going forward here.
Do you expect to continue generating this amount of cash, assuming that the oil price stays steady?
Well, part of the outlook for us, last year we laid out a 5-year plan. We've got growth. We had 7 major projects come on this year last year in 2017. We've got another 6 coming on in 2018. We've got line of sight all the way out through the end of the decade. We're looking to generate much higher levels of free cash flow all the way through to the end of the decade and beyond.
What kind of mode are you in at the moment? CapEx is very tight still. You're definitely pushing down on cost. What would it take you to sort of shift into growth mode? Am I kind of oversimplifying it? So I'm curious to kind of know when you feel that the pressure is off and you need to kind of push ahead rather than kind of maintaining that very strong cost focus.
Well, you look at the capital we've been spending, we have been in a growth mode. 6 major projects in 2017, the largest commissioning of projects we've had in our history, and we have more to go. So we're trying to balance that. We've been balancing the Gulf of Mexico obligations. We've got the assets running 94% availability, both upstream and downstream. So the company's operating and firing on all cylinders here. So growth is part of what we do. We don't see oil field inflation yet. Around the world. You see it in the Permian onshore with the rig crews and other things, but broadly, seismic crews, drilling crews, the yards out there.
Does that come back? Is that something that, when you're looking ahead, are you thinking, right, that kind of inflation has been pushed low for quite a long period of time? Is the kind of, are the services companies due a bounce back in their pricing story?
I don't know any of the major oil companies or the national oil companies that are off to the races against spending. We learned a valuable lesson with that last peak. $100 people thought was normal. It's not normal. We're coming back down, and I think no one has lost that lesson of capital discipline and being careful. I don't see it yet, other than the U.S., where there's just a lot of activity being chased by rig crews, and then you'll see some inflation there.
What do you think about the downstream business, Bob? It was responsible for a lot of misses industry-wide in the quarter, although it was the savior during the downturn. Is that business going to pick up, you think? Is it going to continue to come back and continue to deliver sort of low-margin profits?
Well, we like our downstream, and in fact, this past year is probably the second best year ever on record. Our downstream profits were up 24% over last year. So people sometimes forget the refining business, the marketing, the petrochemicals business. Ours is growing and growing very healthy. So for us, it's not a drag, and I'm really pleased with what the downstream has done last year. And again, 95% operability on the refineries.
There are some businesses that you didn't necessarily need, and you were planning on getting rid of a lot of them. $4-5 billion in asset sales, I think, was your target. 4.5 to 5.5. Did you reach that in 2007, and do you have more to do this year?
Yes, we do have more to do. We've generally set up a financial framework where we meet our obligations in the Gulf through the divestments, and over time we've divested more than $60 billion. We're down at the tail end of that. We had a target of about $5 billion. Some of them closed before the end of the year, some after the end of the year. But we're on track with that. A company the size of ours, given our balance sheet, there are always assets that we will sell. We'll also buy other things. So divestments, that's been going well. We've been getting them at the right part of the cycle.
Any more surprises coming on Gulf of Mexico? Do you think the market sort of trusts you now on that?
Well, some of these claims in the Gulf of Mexico, $65 billion it's cost. I mean, this is an enormous event to come back through, and we'll still have some headwinds. But we started with our claims in the Gulf of Mexico, about 240,000 individual or business claims. We're down, I think we have 600 left in that facility. We're at the tail of it. Can't say they're all done, but most certainly we're provisioned. The company's generating a lot of cash. I don't see any big surprises there.
You've talked about in the past kind of where you will invest in projects or what kind of level, kind of 40 around that kind of point. Does that, if we stay where we are on the oil price, does that number creep higher? Do you sort of look at projects and think, actually, maybe we're in a band, then we're going to be here for a long time? I don't know what it is. I don't know, 50 to 70, whatever it is. Does that number incrementally start to sort of push a little bit on?
Well, I think what you see, we're able to do more with less money now through technology, better designs, phased development of projects. We'll have more options than I think we can afford. So we've got a sight of projects all the way out well into the next decade. We'll pick them carefully. We want higher returns. It's all about returns, not production. So we'll retool projects if we need to get the returns down and pick them very, very carefully. Mixture of natural gas and oil projects. It's a good outlook, and this year we replaced 143% of our reserves. We haven't done that since the early 2000s. Found more than 1 billion barrels of oil and gas equivalent. We haven't done that since 2004. Future looks bright for us. We need to operate it safely, reliability, and that leads to safe and reliable cash flows. That's our plan.